Hello and welcome to the special segment called as MC Pro Select Stock of the Day. I'm your host, Nikki Mitchandani, and in this segment, we bring to you fundamentally strong investment stock ideas. Today, we're going to be talking about Lemon Tree Hotels. Let's get to know more about the company, essentially India's largest hotel chain within the mid-price segment, which has an impressive inventory of around 8,500 rooms, distributed across 90 hotels, situated in 56 distinct destinations. Now, the company is amongst the fastest growing hotel companies. Now, that brings us to a question. Should you check into this hotel stock? A couple of reasons out there. Let's address the first one for you, where the demand momentum remains strong with the recently concluded G20 summit and the eagerly anticipated upcoming Cricket World Cup. The demand momentum in the hospitality industry continues to surge. Lemon Tree Hotels in particular anticipates that its performance in the second quarter will remain solid with the expectation of matching or even slightly surpassing the results achieved in Q1. This is particularly noteworthy as Q2 typically represents a seasonally weak quarter for the company. In fact, if you talk about the second reason, which is huge inventory additional plans, Lemon Tree has an ambitious pipeline for expansion with plans to add a total of around 3,724 rooms to its portfolio. This impressive growth initiative is notable, especially when compared to its current room count of approximately 8,500. What's particularly noteworthy is a substantial 80% of these planned additions will be pursued through asset-light management contracts. Let's get on to the third reason, which is to monetize own hotels and bring down debt. The company is strategizing a move to transfer ownership of 17 hotels, collectively offering 1,800 rooms to its subsidiary Flair Hotels. This transfer is expected to generate approximately 2,000 crore in funds, the funds which will be earmarked primarily for the purpose of reducing existing debt obligation. The move aligns with the company's broader objective of achieving a debt-free status within the next few years. Let's get on to the last reason that we have, perhaps industry upcycle, which is expected only to sustain. Now, the hospitality industry is poised for a positive growth as demand is projected to increase at a compounded annual growth rate of approximately 10% from FY23 to 27. In contrast, the growth in supply is expected to remain relatively subdued, hovering around that 5% mark. This favorable demand-supply dynamics is expected to have a twofold impact. Firstly, it is likely to drive an upward trajectory in the average room rates, enhancing revenue potential for hotels. Secondly, the advantageous situation is anticipated to contribute to increased profitability of the company. Let's also get on to the reason where the company has healthy earnings growth and return ratios, which are only set to improve further. Anticipated, MC Pro is actually anticipating a solid period of growth. It foresees healthy revenue and EBITDA profile of the company and expansion at a commendable compounded annual growth rate of around 16% from FY23 to 25. The growth trajectory is underpinned by improved asset utilization and a strategic emphasis on asset-light expansion. Well, let's talk about valuation in that case. The stock is currently trading at an EV to EBITDA of 18 times 1 year forward projections. The valuation multiple suggests a strong earning growth outlook as the company continues to demonstrate earning growth visibility and execute strategic plans effectively. MC Pro sees a likelihood of valuation multiples experiencing a re-rating here on. With this, it's a wrap. Thank you so much for tuning in.